BlackwellMoore Insights.
Welcome to a new episode of BlackwellMoore Insights.
Let's dive straight into today's topic.
Welcome to the debate. You know, when you look at a massive skyscraper under construction, from a distance, the scaffolding all looks exactly the same.
Right, just a chaotic mess of cranes and steel beams.
Exactly. Whether the developers are building, a structural marvel engineered to stand for centuries, or just a shoddy tower destined to collapse at the slightest tremor. From the street, it all gives the illusion of identical, unstoppable progress.
Because the structure's going up, right? The crowds are cheering on the sidewalk, and absolutely no one is looking at the soil underneath. I mean, nobody is checking if they are building on solid bedrock or a sinkhole of quicksand.
Precisely. The foundation is entirely hidden. And today on BlackwellMoore Insights, we are tackling a multi-trillion-dollar question that is frankly dominating the mid-2026 global equity market. We are putting this current artificial intelligence boom under a microscope.
To figure out if we are living inside a speculative bubble that mirrors the 2000 dot-com crash, or if we're actually witnessing a fundamental structural economic paradigm shift.
And the specific tension we're parsing out today, especially for those applying a university economics lens to speculative markets, is NVIDIA's valuation. Is their current trajectory just a dangerous mechanical repetition of Cisco Systems' parabolic rise and fall?
Or is it fundamentally justified by unprecedented corporate liquidity? Not to mention the real-world cost reductions driven by, agentic AI. And we should state right up front, as always, while we will be analyzing real-world balance sheets and market behaviors, we are discussing macroeconomic structure here. We are not providing financial advice.
Right. No financial advice. So this discussion is rooted in our analysis of mid-2026 macroeconomic data, the recent quarterly financials of big tech, and some theoretical frameworks from the Financial Times. Now, for my part, I argue that 2026 represents a structural paradigm shift. It's backed by concrete, undeniable cash flows and a genuine era of industrial automation.
And I contend that the market is completely blinding itself. Extreme cyclicality, massive physical infrastructure bottlenecks, and capital saturation expose this entire hardware ecosystem to severe, classic bubble-like risks.
Okay, let's start with the foundation then. The financial media has completely fallen in love with this incredibly lazy analogy. They just take NVIDIA's steep upward trajectory and place it directly over a chart of Cisco Systems from 1999 and 2000.
Yeah, it makes for a terrifying headline.
It does, but it is fundamentally flawed at the balance sheet level. If you are seriously analyzing speculative bubbles, you cannot just look at the stock price. You have to look at what I call the PE compression paradox.
You mean the divergence between the actual stock price and the underlying earnings multiple?
Exactly. Usually, when a stock goes parabolic in a true bubble, the price-to-earnings ratio just explodes into the stratosphere. The price detaches from reality. I mean, at its peak, Cisco reached a trailing PE of over 130x.
Right, a valuation based purely on future promises.
A hallucination. But NVIDIA is a completely different mechanical beast. Over the last 2 years, as its stock rallied massively, its forward PE actually stabilized. It compressed, dropping down into the 30x to 40x range. And why? Because the denominator, the actual liquid earnings, are hitting the ledger every 90 days. The cash generation is literally outrunning the hype.
I see the mathematical logic there, sure. But it completely ignores the mechanics of hardware cycles. Just because earnings are materializing today doesn't mean they aren't uniquely vulnerable tomorrow.
Vulnerable how?
You cannot ignore the fact that the hardware layer is deeply cyclical. The core thread here is CapEx satiation. We have the hyperscalers, companies like Microsoft, Meta, Google. They're spending $40 to $50 billion annually on infrastructure. That is a staggering capital expenditure.
It's massive, yes.
Right. So if they do not see proportional immediate revenue increases from their own cloud clients, what is the logical next step? They don't cancel everything, but they pause. Just a 2-quarter pause in hardware procurement would trigger a violent cyclical drop in NVIDIA's revenue, and that compresses your precious PE ratio in the worst possible way.
Okay, but you're assuming a level of fragility in their customer base that simply doesn't exist anymore. To really understand why the Cisco analogy fails, we have to look at the micro-mechanics of demand, specifically the counterparty quality. Who was Cisco actually selling to in 1999?
Well, mostly telecom startups.
Yes, but it was worse than just startups. Cisco was engaged in massive vendor financing. They were essentially lending money to fragile, highly leveraged telecom companies funded by volatile venture capital and high-risk junk bonds, just so those startups could turn around and buy Cisco routers.
A circular economy of debt.
Exactly. It was a house of cards. When the credit markets froze, Cisco wasn't just left with canceled orders. They were left with billions in defaulted loans and worthless inventory.
NVIDIA is not lending money to fake companies. They are selling to the hyperscalers: Microsoft, Alphabet, Meta, Amazon.
Okay, but
Wait, let me finish the thought. These entities possess the strongest, most liquid balance sheets in human economic history. When NVIDIA books $25 to $30 billion in quarterly data center revenue with, 75% gross margins, it is cold hard cash clearing the bank. Having the richest customers on Earth doesn't grant you immunity from the fundamental laws of hardware commoditization. Cisco's standardized routing hardware was a cash printing machine too, until it was easily reverse engineered and replicated by overseas competitors.
But a GPU isn't a simple router.
Their margins crashed to 60%, forcing massive write-downs. NVIDIA faces the exact same medium-term gravity, and the threat is coming from 2 incredibly well-resourced fronts right now.
Oh, I completely disagree that a GPU is comparable to a standardized network router, but go ahead. Lay out your 2 fronts.
First, open-source software models. Meta's Llama series has proven that advanced AI capabilities can become a public good. When the model is free and hyper-efficient, enterprises just don't need to overpay for dedicated, ultra-premium infrastructure to run it.
And the second front.
The threat is coming from inside the house. NVIDIA's own massive customers are actively trying to destroy NVIDIA's pricing power by developing custom internal silicon. Google has its tensor processing units, Amazon is deploying Trainium, Microsoft has Maya.
They're trying, yes.
They are spending billions in R&D specifically to break their monopolistic dependence on NVIDIA. When these alternative custom architectures reach parity, those 78% profit margins will absolutely crater.
See, you're treating NVIDIA's platform like a physical commodity. You're looking at a GPU like it's a barrel of oil or a copper wire. It's not. The actual moat is an entire ecosystem locked in by their proprietary CUDA software and their NVLink architecture.
But software lock-in can be broken.
Not easily. CUDA isn't just a driver. It operates as a sticky, universal operating system for parallel computing. Every major AI researcher and developer has spent the last 15 years writing code optimized specifically for CUDA's mathematical libraries.
Sure, but AMD and others are building translation layers to run CUDA code on their chips. It's happening.
Translation layers introduce latency and bugs, which is completely unacceptable when you're training a trillion-parameter model costing $50 million a run. To bring back our skyscraper analogy from earlier, abandoning CUDA for custom silicon isn't just swapping out a tool on the construction site.
What is it then?
It is trying to core an entirely new concrete foundation while the skyscraper is already 100 stories high, fully occupied, and conducting billions of dollars of business. It is incredibly risky and disruptive.
It is disruptive, certainly. But if the rent on that foundation becomes extortionate, a $1 trillion tenant will figure out how to pour new concrete. They have the engineering talent to do it. But okay, let's follow your logic.
Please do.
Let's assume the CUDA foundation is impenetrable for the next 5 years. We must then look at what is actually running inside the skyscraper to justify the cost. Because if the hyperscalers are buying all this hardware, their enterprise customers better be paying them for the software.
And this is exactly where the economic paradigm shift solidifies. We have to clearly separate the 2023 hype cycle from the 2026 industrial reality. 2023 was driven by FOMO. Companies were throwing millions at large language models that were strictly conversational.
Right, chatbots.
Exactly. A chatbot helping you draft an email is neat, but it's not autonomous. And frankly, it's very difficult to monetize at an enterprise scale. It was treated as an R&D expense. But today, we have transitioned to agentic AI.
Break down the actual mechanism there, because a lot of people throw around agentic AI as a buzzword. How does it physically differ at the software level, and how does that translate to a corporate balance sheet?
The difference is autonomy and multi-step execution. A conversational AI waits for a prompt, gives an answer, and stops. An agentic AI operates in a continuous loop.
Give me a real-world example.
Let's look at supply chain logistics. An agentic system constantly monitors a company's API. It notices a raw material delay from a primary supplier in Asia. Without a human ever prompting it, the agent calculates the production shortfall, emails a secondary supplier in Europe to reroute a shipment, updates the enterprise resource planning software, and adjusts the localized pricing model.
Wow. All autonomously?
Entirely. Global banks like JPMorgan Chase are currently using these autonomous agents to handle massive legacy code refactoring. SaaS companies have deployed customer-facing agents that can actually resolve complex billing disputes end-to-end. They are actively reducing human customer support headcount by 40 to 50%.
That's a massive operational shift.
It is. This isn't an experimental pilot anymore. Buying compute today structurally slashes fixed corporate operational expenses tomorrow.
Okay, that is a highly compelling operational reality. But let me step into the shoes of an institutional portfolio manager who is staring down the barrel of market volatility. If we are applying an economic lens to speculative bubbles, we have to analyze the asymmetric risk profile between the software layer and the hardware layer.
Meaning who holds the long-term value versus the short-term risk.
Exactly. Let's completely concede your point. Let's agree that the ROI on the agentic layer is real, and banks are structurally cutting OpEx. The portfolio manager doesn't just care about the software success. They care about asset pricing and capital structure.
Right.
The hardware layer remains a classic cyclical trap because of how revenue is recognized. If Microsoft buys $5 billion of GPUs, NVIDIA books that revenue point in time, today. But software revenue is amortized. It's a sticky, monthly subscription. If the ultimate long-term economic value is locked in those autonomous agents, the hardware providers are entirely exposed.
I don't see how the success of the software exposes the hardware. They're totally symbiotic.
They are symbiotic until the CapEx satiation point hits. The moment the software layer becomes hyper-efficient, or the moment those hyperscalers decide they have enough compute capacity for the next 12 months, they simply pause new hardware orders.
But they don't cancel their software subscriptions.
Exactly. Those keep generating value, but NVIDIA's quarterly revenue growth drops to zero. That creates massive volatility. The structural value of AI remains intact, but the financial bubble of the hardware stock violently pops.
I see the mechanics of your argument, but it assumes a static environment. It assumes a strict, clean endpoint to compute demand. I think we are drastically underestimating the constant compounding need for upgraded compute.
How so?
You don't just buy the hardware once and call it a day. As these autonomous agents become more complex, moving from managing customer service tickets to running entirely automated quantitative trading desks or drug discovery pipelines, the compute required to run them scales exponentially.
You don't buy it once, no, but you do pause buying when your infrastructure ambitions violently collide with the physical limits of the real economy. And that brings us to the ultimate reality check.
You're talking about the macroeconomic constraints, which actually leads us to a fascinating theoretical framework from Martin Wolf at the Financial Times regarding the concept of a productive bubble.
A concept that I think historically misinterprets the current physical reality, but please lay out Wolf's thesis for us.
Well, history teaches us that human beings consistently overhype new technologies in the short term, leading to financial mania, but we radically underestimate their transformative economic power in the long term.
Wolf points to the British railway mania of the 1840s.
Right, where everyone lost their shirts.
Tens of thousands of retail investors lost absolutely everything when railway stocks crashed. It was a brutal financial bubble, but when the dust settled, the physical iron tracks were still in the ground. That overcapacity of infrastructure permanently slashed transportation costs across Britain and essentially triggered the second phase of the Industrial Revolution.
And the dot-com crash is the standard modern equivalent of this overcapacity.
Exactly. In 2000, thousands of web companies vanished overnight. Trillions in market cap were decimated. But the bankrupt telecom companies left behind millions of miles of cheap, dark fiber optic cables buried in the ground.
A massive overcapacity.
Yes, and that became the foundational, dirt-cheap infrastructure that allowed Web 2.0 companies like Amazon, Netflix, and Google to scale a decade later without having to lay their own cables. So applying this to 2026, even if we see a 20 to 30% market correction in tech valuations due to your CapEx satiation fears, the infrastructure is still there.
You mean the GPU clusters?
Right. These massive clusters of globally connected GPUs are already built and paid for. If the bubble pops, the cost of renting compute will crash. This democratizes AI deployment for the broader economy. Small businesses and local supply chains will have access to enterprise-grade agentic AI for pennies on the dollar. The financial bubble, if it pops, acts as a massive subsidy for global real GDP.
That is a beautiful, elegant theory, but this is exactly where Wolf's analogy completely breaks down under physical scrutiny. You are dangerously conflating capital saturation with physical thermodynamic limits.
Both involve massive infrastructure buildouts. How are they really that different?
Look at the nature of the infrastructure itself. Iron railway tracks and fiber optic cables are passive. Once they are laid in the ground, they lay dormant. A dark fiber cable does not consume resources while it waits for Amazon to catch up to the demand. It just sits there.
Okay, and GPUs?
AI GPU clusters are fundamentally different. They are active, hungry engines. They require massive, continuous gigawatts of power just to operate, and nearly as much power just to cool them so they don't physically melt.
The energy footprint is undeniably massive, sure. Which is why we are seeing such aggressive expansion into renewable energy and nuclear capacity by the hyperscalers. Microsoft and Amazon aren't ignoring this. They are actively funding next-generation power.
They are funding it, yes, but money cannot bypass the laws of thermodynamics or the timeline of local utility supply chains. Data centers are hitting a massive, immovable wall of power bottlenecks globally. We have regions in the US and Europe that literally cannot supply the gigawatts required to spin up these new supercomputers.
The grid is struggling, yes.
The local utility transformers physically cannot handle the load. So if the electrical grid capacity cannot support them, your tracks are useless. They aren't dark fiber, waiting patiently to be lit up. They are stranded, depreciating assets that cannot be turned on because the utility grid physically cannot route enough power to the building. This totally stalls the democratization of AI that you're banking on to boost global GDP.
You're identifying a very real constraint. I'll give you that. But you are looking at this purely through the lens of commercial energy allocation and private sector ROI. You are ignoring a massive structural wildcard that alters the physics of demand completely.
And what is that?
Sovereign AI.
Government intervention in the compute market?
Not just intervention, domination. Governments worldwide, from the European Union to the Middle East to the US Department of Defense, have stopped viewing AI compute as just another private sector tech commodity. They are treating it as a sovereign utility, deeply tied to national security, defense logistics, and technological independence. They are actively building state-owned, air-gapped data centers.
Even a sovereign government needs a high-voltage transformer, which has a 3-year manufacturing backlog. You can't just legislate a transformer.
But governments have tools that private hyperscalers do not. When a nation state decides that compute capacity is equivalent to a weapon system or critical infrastructure, like a water treatment plant or a missile defense shield, it becomes completely decoupled from Wall Street's quarterly profit metrics. They don't have to wait for commercial ROI.
That's true.
Furthermore, they don't have to wait for local zoning boards.
Through mechanisms similar to the Defense Production Act or eminent domain, governments can and will forcibly reroute commercial power grids. They can prioritize power allocation away from heavy industry directly to sovereign data centers. This massive state mandate provides a structural floor to hardware demand that completely transcends your fears of CapEx satiation. They will mandate and subsidize the power grid expansion by decree for national security reasons.
They might subsidize it, and they might use eminent domain, but you still cannot legislate a nuclear reactor into existence in a fiscal quarter. Permitting a new nuclear facility or entirely upgrading a national transmission grid takes a decade. The timing mismatch between the hyperspeed of Wall Street valuation and the glacial pace of physical infrastructure development is the exact definition of a speculative risk.
Fair point.
But looking at the geopolitics, I do see your point about how the market structure is fundamentally shifting away from pure enterprise economics.
Right. So let's bring this all together and summarize where we stand today. My position is that despite the high valuation multiples causing anxiety, calling this a simple dot-com bubble repetition is analytically lazy. We are looking at a true economic paradigm shift.
Supported by actual revenue.
Exactly. The foundation of this market is built on concrete, highly liquid cash flows from hyperscalers, entirely unlike the junk bond vendor financing of the 1990s telecoms. Furthermore, the evolution from chatbots to agentic AI is actively driving down corporate OpEx, creating a provable, real-world return on investment. And even if we face a cycle of asset price volatility, the legacy of this productive bubble ensures a long-term democratization of compute power that will permanently alter global productivity.
And my position maintains that any sober economic analysis must respect the extreme cyclicality of the hardware market. You can have brilliant, cost-saving software and incredibly cash-rich customers, but the CapEx saturation point is a mathematical inevitability.
The dreaded pause.
Yes. If infrastructure spending pauses because hyperscalers digest their capacity, the revenue drop for hardware providers will be violent. Furthermore, you cannot wave away the physical limits of global power grids, the transformer supply chain shortages, or the looming commoditization of hardware via open source models and custom silicon. Ignoring these physical and cyclical factors risks repeating the very speculative disasters we study in university history courses.
Yet, despite our disagreement on the timeline of the risk, I think we have found some crucial areas of convergence today. We both agree that the current market structure is highly asymmetric in its risk profile.
Absolutely. Asset prices today carry significant speculative weight. The FOMO is undeniably driving retail and institutional trading behavior, pricing in perfection where perfection rarely exists.
But at the same time, we both see that the long-term economic value, the true productivity gains that will reshape global GDP, will ultimately be locked into the application and agentic software layers over the next decade.
Correct. If you're a portfolio manager constructing an investment matrix, you have to acknowledge that the hardware layer is deeply cyclical and highly vulnerable to sudden demand pauses and power bottlenecks. Meanwhile, the software layer is where the structural, sticky productivity gains will actually compound over time.
Exactly. The real value of this exercise is looking past those lazy media headlines. You cannot just draw a one-to-one comparison of NVIDIA and Cisco on a price chart, yell bubble, and walk away. You have to dive into the nuanced mechanics of balance sheets, the reality of cash flows, and the hard limits of physical infrastructure.
There is definitely much more to explore in the source material, particularly regarding those sovereign AI dynamics you highlighted, and exactly how institutional leaders are attempting to navigate the divergent timelines of hyper-fast hardware cycles versus sticky, slow-rolling software applications.
So, it seems we return to the construction site. The cranes are swinging, the steel is rising into the clouds. And from the street level, the scaffolding looks awfully familiar to anyone who survived the year 2000. But the real question for the future of the global economy isn't just how high the tower goes today. It's whether we are building on the quicksand of speculation or if we have finally struck the bedrock of a new industrial reality. We'll leave it to you to decide.